All right, so now you have my whiteboard in front of you, and this is the start of the Financial 15. So if you're just joining us, let me just go back here for a second. If you're just joining us for this Financial 15 segment, this is the financial planning portion of our weekly webinar, or what we call our Financial 15. So this should be about 15 minutes or so of our financial planning topic. And what you've just missed is our the remaining portion of our weekly webinar that typically runs about 45 minutes to an hour. So so for the last 40 minutes, we've been talking about IRA distribution issues, some headlines. We talked about consumer price index today, and we went over some investment returns from last week and some analyst reports. But if you're just joining us for this Financial 15, then please hit the like, notification, and subscribe button so you never miss an opportunity to hear one of our or watch one of our videos. Thank you, Kathy. Kathy got the clarification that she needed on the distribution. All right, so this is not an exhaustive checklist. I put this checklist together as we're going through things, and honestly, just right before our webinar this morning, I said to our lovely office manager, Jess, I said, hey, here's my list. Are we missing anything? And she added a couple key elements, so I appreciate that, Jess. So these are things that most of them, right? So here, I'm going to draw a line here. These are things that must be done by December 31st for at the count for 2023. We're in year 2023. If it's now 2025 and you're just listening to this, it probably still applies unless the law has changed, but we're talking about 2023 today. So the first is RMDs. I can't talk about this enough. What are RMDs? If you don't know, RMDs are required minimum distribution. That's the amount that the IRS says you must take out of your IRAs. And if you don't take it, there is a penalty. The penalty used to be 50% of what the required minimum distribution was to be. Now it's 25%, and it can be reduced to 10. Still a significant penalty. So you must take your required minimum distributions. We've talked before about how that's calculated, but you need to calculate those RMDs, or have your planner or advisor calculate those RMDs for you. It is ultimately your responsibility, though. You should know that. We help our clients. We distribute the RMDs. We keep and Jess, who I just talked about, she does all of this, really. So she keeps a spreadsheet and she makes sure that they're done throughout the year. But it is, in fact, ultimately the client's responsibility. So make sure your RMDs are distributed by December 31st. The money must leave your IRA account by December 31st. Folks, you never want to wait till December 31st to get these things done, because folks, a lot of people wait, and the custodians get inundated with end of year requests, and they hit a point. And I don't recall what our custodian, we happen to custody at Charles Schwab, but it doesn't matter if it's Fidelity, it doesn't matter if it's Vanguard, it doesn't matter if it's whomever. They typically have a cutting off point where they say, we'll process this, but you're getting what's called best efforts. You don't want to count on best efforts. So RMDs, that's your first checklist. Make sure your RMD is done. Now, that is if with your own IRA, and today, the rule is greater than 73 years old. If you turn 73 in 2023, you technically have until April 1st of the year following the year you turn 73 to distribute that RMD. But most people, that doesn't make sense. But anything greater than age 73, you've got to process that RMD by 12/31 of the year. So make sure that's on. So your own IRA, and maybe it could be an inherited IRA. Now, I can't go into this because there's just too many ifs, but it could be that if you have an inherited IRA, you also have to take an RMD. And this is confusing for folks because even with the 10-year rule now, and yes, the IRS has allowed some people to forego, or they don't apply a penalty for the last 2021, 2022, and now 2023 because of all the confusion they've created around this. But if you have an inherited IRA, you may have to take that by the end of the year. And if you're not sure about that, I'm just going to pull this up again. You can contact us at questions@attleborowealth.com. That's questions@attleborowealth.com. And I just dropped my pen, so I'll be right back. Hold on. Okay, so that's RMDs. That's your first thing. How about tax loss harvesting. We did a whole video right here. We did a whole video a few weeks ago about tax loss harvesting. So that is when you have positions, mutual funds, exchange traded funds, individual stocks, individual bonds, what have you, in a non-IRA account. Now remember, if we're looking at our account buckets, we have our taxable bucket, our tax deferred bucket, and then our tax-free or tax advantage bucket. I'm talking about investments that live in this taxable bucket. If you have losses, embedded losses, unrealized losses in those investments, you bought X, I can't even name a stock, ABC stock at $50 a share, and now it's trading at $40 a share. You can sell that position if it's in this taxable bucket and realize that loss. And even if you wanted to still own that position, you rebuy it 31 days later and realize that loss, but that sale must be done by December 31st. If you don't do it by December 31st, it doesn't offset gains for this year. You can carry over those gains those losses for following years. But if you want to use those losses for 2023 to offset gains or even offset income, because you can do up to $3,000 a year to offset income, then you must do that tax loss harvesting by the end of the year. It's only for the taxable portion, not tax deferred, not tax free, only for taxable portion. So it must be done by the end of the year. Roth conversions. I get asked this all the time because Roth contributions, if you're eligible to make contributions, you can do contributions until your tax filing deadline the following year. So yes, I can still make a Roth contribution if I'm eligible for 2023 into 2024, or the following year. But Roth conversions must be done by the end of the year. And you cannot wait. You should not wait until the last minute on this either, because same as required minimum distribution, the custodians, the people who hold your money and produce your statements, often say, we'll process this after this date, but it's best efforts. That means it may or may not get done, and they're not taking responsibility for it. And you've got to confirm these things. You send these, listen, we use Schwab as custodian. We have no ties to Schwab. They simply hold our clients' money, produce statements, do tax reporting for our clients. We are not Schwab advisors. We just use them as a resource. Schwab bought TD Ameritrade. A merger happened this year. It makes things more challenging. I'm sure it's going to be a great organization by the time they're done, but they're very, very overworked with this merger and really trying to pull things together. I'm really thankful that we started on the Schwab side, not the TD side, because we just all might be pulling out our hair. But my point being is that once you submit a piece of paperwork or an electronic request to a custodian or an investment firm, you can't just assume that it's done. You have to go in and double check. We double check all Roth conversions we do for our clients. We double check all required minimum distributions we do for our clients. You should do the same. You should do the same. Double check to make sure these things are done, because they must be done by the end of the year. Roth conversions must be done by the end of the year. You cannot go back. Retirement plan contributions. I'm talking about 401ks, 403b plans, simple plans, simple plans, retirement plans. These cannot be, you cannot do next year contributions, right? Contributions in the following year for the prior year. So if you want to put more money into your retirement plan, it has to be payroll deduction. You may have one more, maybe two more pay periods to increase your retirement plan contributions. This is why we start talking about year-end planning, and we do our financial planning with our clients every year. But we start talking about year-end planning in September, because if a client said, "Well, geez, I wanted to max out my retirement plan, but it doesn't look like I'm going to get there," they could put 100% of their income into the retirement plan if they wanted to maximize their contributions up to the end of the year. But you may have, if you haven't put as much money as you'd like into your retirement plan, you may still be able to increase those contributions for the remaining of the year.